I was asked as a question after a presentation last week, what did I think of the Australian bond market, and whether I think that the rally in Australian bonds ought to be going. So what I've done in updating the quarterly, I've updated our model of US Treasury bonds, German bonds, and Australian 10-year bonds. And all of them show that a rally in bonds is in progress. But it also provides us with some kind of warning that the reverse might happen as we get into the new year. When we look at our model of US 10-year bonds, there's 40 years of data in the model going back to the beginning of the 1980s, and it explains 88% of monthly variation over that long period. Fair value for US 10-year bonds in that model, including what the Fed has already done rather than the Fed might be about to do, gives us a fair value for the US 10-year bond of 5.4%. Now, US Treasuries yesterday, when I was doing the model, were almost 1.6% lower than that in where they were trading. They were trading at 393 basis points. German bonds, the model for this, we use 30 years of data, and it explains 95% of monthly variation in German 10-year bonds. And what I see in this model, which is similar to the other models, but more importantly in the European case, is it's not really so much what inflation is in particular countries. It's what the central bank thinks it is. That is to say, the impact of central bank interest rates is actually greater than the impact of inflation. And just keep that in mind for for the discussion at the end of this. So in that case, what's happening in German bonds is that the Europeans are delighted at the experience of actually having positive yields on German bonds for the first time in 10 years. German 10-year bonds are yielding 2.2%, which is about 55 basis points lower than the model, which is about 2.57%. Australian 10-year bonds, our model explains 97% of monthly variation based on 30 years of data. Our model says fair value for our bonds right now, given all those other variables, is about 4.8%, but actually they're trading about 120 basis points lower than that. So the question is, all the models are showing that the bonds are overvalued based on what the central banks have already done. And we know that central banks are going to do more as we go into particularly the first quarter of next year. So obviously that gives us a warning of possible danger in the bond market as we go into next year. But why is that happening? Why is the market so different in its attitude to the future of the next year or the next 5 years or the next 10 years than central banks are? There's a couple of reasons for that. The simplest explanation is the European experience. European banks, particularly commercial banks, have had as I say, a terrible time for the last 10 years with negative interest rates, and it's incredibly difficult for them to make money, lending money at a negative return, and hence they've tended to provide an enormous amount of funding to the US market, where they've been able to get positive yields. Now that they've got positive yields in other places, they're really happy to address them, particularly because the level of the US dollar real exchange rate is so high. And the fact that the level of the US dollar exchange rate is so high generates a potential capital loss for investing in US dollar securities rather than its own securities and the securities of other countries. For example, Canadian bonds or Australian bonds, where risk is relatively low and where yields are relatively high. So I think it's been European interest in our market which has driven our bond yields lower, and I think that's the same thing for for Canadian bonds. But there's something else happening in terms of the US market view about inflation, and it's captured in an article this morning in the New York Times by Paul Krugman, who's an economist who writes for the New York Times. But it reflects the work of somebody I've talked about over the last couple of years, who was the chairman of the Council of Economic Advisors, not during the Trump administration, but the Obama administration. His name was Jason Furman. And he's published work on US rents. And it compares what this US CPI would look like if you included the data from Zillow, which shows that new rents in people newly renting accommodation in the US, and you included that in the CPI instead of the data for all of the people who are currently renting, which is how the CPI is currently done. And when he does that, what happens is that inflation takes off much, much faster than it did in the official number. And indeed, US inflation goes all the way up to around about 16% by July 2021. But then it begins to decline. And now, instead of running at around 6% core inflation or 7% headline inflation, that level of inflation, including those new rents, has fallen down to between 2 and 3%. That is to say, inflation has already fallen down to where the Fed target is. Of course, the Fed doesn't believe in this measure. It believes in measuring all of the people who are paying rent. But what it does perhaps indicate is that, at least as far as the US market, professional market is concerned, the view is swinging around from high inflation to falling inflation, and that is supporting a much stronger interest in US bonds, European bonds, and indeed Australian and Canadian bonds.